this series of pre-scene analysis videos, we'll be taking a look at the November 2019 management case study from CIMA. The pre-scene document deals with a fictional business by the name of GSC that is involved in sportswear. And over the course of the next 10 or so videos, we'll be working through each page of the pre-scene document in detail, and I'll highlight the most important topics as they come up. I'll point out how they relate to key theories from E2, F2 and P2, and I'll talk about some likely exam issues along the way. So looking at the first page of the pre-scene document, you're told that you are a finance manager working for GSC, a global business which designs, markets and sells high-performance branded sportswear. So it's interesting that there is no mention of manufacturing, and as we will see later on, the manufacturing of the sportswear that this company sells is actually outsourced to a number of third-party specialists. So GSC, we're told, sells clothing, footwear and sports accessories. We'll see that clothing is overwhelmingly the most important revenue generator for this business. GSC is based in the North American country of Geoland, so it's a fictional business in a fictional country. Geoland, we're told, has a population of over 200 million. So right away, we're thinking about the real life country of the United States. Like the United States, it has a highly developed economy, so it's likely that domestic demand conditions are going to be quite favorable. You think of Porter's diamond, which you would have come across in your enterprise studies, and factor and demand conditions. Certainly, with a highly developed economy, it's likely that the consumers will have a good degree of disposable income. When you talk about factor conditions, then it's likely that there would be good infrastructure in place, so transport networks, etc., would be quite good. And it's likely that the population would have good access to healthcare, education, etc. So there's a degree of sophistication in terms of the kinds of consumers that you are selling to. Moreover, the people living in Geoland have a keen interest in health and fitness activities, and there are many sports teams and famous sports stars that live in Geoland, and they generate lots of interest in relation to sports and sportswear. Furthermore, two of the world's largest sportswear businesses are also based in Geoland, so the competition in the domestic market is likely to be quite fierce. And if GSC can survive that competition, it's likely to have to be better prepared to go into other countries throughout the world. So domestic competition, in accordance with E2, is both an advantage and a disadvantage. It can be disadvantageous in terms of the threat it represents to your own business. So if you can survive that threat, you have keener senses as to how to conduct your business in other markets. Because we're talking as well about a global organization, we're reminded of some of the key features of globalization. With globalization, there is increasing interdependence between countries as flows of trade become more pronounced. The spread of labor, finance, etc. is more pronounced where you have a globalized economy, and technological breakthroughs are spread more quickly as countries learn from one another as trade barriers come down. Now, you would say that globalization has been a major economic force over the last 30 or 40 years, particularly, for example, with the opening up of China to the rest of the world. However, in recent times, over the last 3 or 4 years, there's been a little bit of a pushback against globalization. Trade barriers have started to come up again. We've got a current dispute between the United States and China in relation to trade, where one is threatening the other with tariffs and impediments to free trade. So in recent times, there's been a little bit of a pushback, but the general trend over the last 30 or 40 years is to a more interconnected global economy with increasing flows of trade between countries. So, undoubtedly, a company like GSC would have taken advantage of that increasing trade between countries. So you yourself work in the finance function at GSC's headquarters in Geoland, and you report directly to the financial controller, who in turn reports to the chief finance officer. So you're no longer a lowly finance officer as you were at the operational case study. You're moving up in the world, and you're now interacting with people with more senior positions. Your responsibilities relate to management accounting and ensuring the effective implementation of the strategic plans laid out by board members at GSC. You will also have the CFO delegating some responsibility for different financial areas to your team. Geoland's currency is also fictional, the G dollar. Given the fact that it is a globally diversified company, it means that there will be cross-border transactions. That means that they will be dealing with other currencies, and some of those foreign currencies will need to be translated back into G dollars. That exposes the company to adverse exchange rate movements. So that means currency risk, which you would have come across in F2. So, thinking about your role as a finance manager, you will have responsibility for monitoring the implementation of strategy. Strategy is being determined at the higher reaches of the company by board members, by the senior executive players, and it's up to you to ensure that it is well implemented. You'll have a medium-term focus, so maybe 1 to 3 years, in relation to choosing or recommending the right kinds of products, the right kinds of prices, the right kinds of financing that you would put in place that will be increasingly long-term in nature. You will also be expected to suggest ways of mitigating risks in relation to those longer-term strategies. You'll be dealing with more advanced financial reporting. Indeed, you're likely to be dealing with consolidated financial statements. Because you're dealing with senior management, you'll be expected to influence them. So people skills and leadership skills come more to the fore in the management case study than they were in the operational case study, where technical skills were really much more important. You will be expected not just to consider your own company, but the wider context within which your company operates. So you'll be expected to think about competitors, you'll be expected to think about shareholders, you'll be expected to think about your impact on the environment as well. P2 is important at the management case study. Some major issues that regularly come up in the management case study in relation to P2 will be managing costs. So you might be thinking about activity-based costing compared with more traditional forms of costing, standard absorption costing and the like, customer profitability analysis, total quality management, cost of quality, just-in-time, and theory of constraints. Because your focus is more long-term in nature and it's not day-to-day as it was for the operational case study, you'll think also of target costing in relation to the long-term profitability of the company, and you'll consider the value chain within which the company is operating and how to ensure that linkages in the value chain are optimized. Pricing strategy is going to be important over the medium term as you think about the demand curve and maximizing profits. And if you've got a global enterprise such as GSC, it might well be that transfer pricing is going to play an important role. So make sure to revise all of those key theories as they relate to P2, and they're commonly tested at the management case study. Let's take a look at the background to the sportswear industry. Sportswear, we're told, is worn mainly during workout sessions or while playing sports, and the idea is to provide the wearer with comfort and agility during their activity. Sportswear is categorized into three main areas. You have sports clothing, you have footwear, and you have accessory. And GSC has a presence in all three core areas, but we will see that by far the most important category for GSC is sports clothing. And the demand for sportswear, we're told, is growing globally. The average growth over the last 5 years has been 4% per year. So that is ahead of annual GDP growth in global terms. So it's not too bad, but it isn't exactly spectacular growth. However, the real-life industry figures point to expected cumulative average growth rate of 10.4% from 2019 to 2025. So, in other words, growth is expected to pick up. So we could probably say that in accordance with your E1 studies, the industry life cycle, we have an industry in the growth stage of its evolution. Certainly, that's good news for a globally diversified firm like GSC. Now, much of this growth in demand for sportswear in the last 5 years can be attributed to increasing levels of health awareness amongst the general public and increasing ranges and availability of fitness activities. As well as that, you have increasing levels of disposable income. So all of those are social factors that play into this growth, and that will be expected to go on over the next 5 or 6 years, and that'll contribute to the increased growth that we talked about that's expected in the industry. So certainly demand conditions are looking pretty positive for GSC over the coming years. The sportswear industry has also been influenced by the increasing participation of women in sports and fitness activities, we're told. That has undoubtedly created an opportunity for sportswear businesses to exploit the general trend towards more casual, sports-based clothing for general day wear, particularly amongst women. So while it said earlier in this page that sportswear is meant to serve a purpose predominantly to provide comfort for the wearer while they undertake sports activities and agility, so it's functional in other words, there is also a fashion element. So people wear sports gear on a day-to-day basis. And indeed, the highest growth segment projected over the next 5 or 6 years between 2019 and 2025 is the women's segment. It's expected to register annual growth of 10.7% between 2019 and 2025. And indeed, some of the major growth markets are in India and China. These are potentially very lucrative regions for the growth in women's sportswear. Certainly GSC should be looking at those two massive markets. The sportswear industry is regarded as part of the overall fashion industry. Therefore, general trends in fashion often come down through to the sportswear industry and have a big influence on what people are wearing when they're doing sports. Indeed, some famous fashion designers have been commissioned to create clothing lines, and indeed celebrities are often used to promote sportswear. So that ties into the marketing strategy that sportswear companies like GSC would be employing. So it's not just athletes, etc., that are being used to promote sporting goods. It's celebrities, musicians, etc., that you'll often see promoting sports goods. Now, GSC is not currently using celebrities, actors, singers, etc. There's talk later on of them sponsoring athletes and sports teams. So it's a different way that they could use to perhaps market their sports goods. On the next page, we're provided with the background of GSC. It was formed in 2000 by a group of 4 friends who had undertook an entrepreneurial spirit workshop together. So 19 years on the market, that indicates that the company has a degree of staying power. And what the 4 friends realized was that there was a little bit of a problem in the sportswear market. Popular sportswear brands, they'd become too fashion oriented in the friends' view, and functionality kind of went out the window. It was seen as secondary, behind the appearance, and that meant that there was a general lack of availability of high quality, high performance sportswear. So that was the niche that the 4 friends identified. So it's a niche strategy, a focus strategy. And that ties into your E2 studies, Porter's generic strategies. You can either be a cost leader, or you can go for something more differentiated with more of a focus on quality, aiming to sell at a higher price. There are some drawbacks, of course, with a more focused strategy. You miss out on the mass market. If you're selling to many customers, you can spread your costs over a wider group and drive down your unit costs. Of course, with higher quality, you tend to have higher production costs. So that's one of the challenges that GSC is likely to be facing. However, the founders, they wanted to focus on quality. They wanted to provide athletes of all abilities with clothing of high quality, with high quality fabrics, comfortable fits, very durable, and optimized for the different sports that people were doing. Of course, if the fabrics are more high quality, they're going to last longer, so they will be replaced less frequently. And that again is kind of one of the drawbacks of this differentiation focus and more high quality offer. There isn't as much obsolescence built into the product, so it's not going to be so customers won't be running out to replace their GSC t-shirts and tracksuits every year. Rather, it would be every 3 or 4 years instead. They conducted market research to confirm their view, their hunch, that there was a demand out there for functional, durable sports clothing. And after this market research, they launched the brand in 2000. So the aim is to sell high quality performance sports clothing across the world. The first range was launched in 2000, and luckily it proved to be very popular indeed. And it was aimed at runners initially. Since then, the company has diversified by targeting a number of different athletes, sports participants across a wide range of sports. And overall, this focus on quality has been very successful indeed. In the first 4 years, the perception in the market was very good. The company was seen as forward-thinking in terms of its designs, the fabrics it was using, and it was all aimed at optimizing athletic performance rather than focusing on lower quality but more fashionable pieces. So, again, talking about the product life cycle, we're witnessing rapid growth in this early stage of the business. So this rapid expansion. We might ask the question right now, how was it financed? Because we see that after the first 4 years, the company was already selling to participants in 15 sporting activities. They were selling in 40 countries over a number of different continents, and they had several retail partners. So very rapid expansion in the early stages of the business. And we have our answer here as to how the early expansion was actually financed. There were high levels of growth and profit in the early years, and the company was reinvesting a lot of that and to fund the expansion of the product range, and indeed to fund the expansion in geographical terms. Furthermore, the company took on debt, and it used that debt to finance this expansion. We're told that since the launch of the company, the growth achieved by GSC arose through organic expansion largely in those early years. So that means they were not acquiring other companies. Instead, they were using the profits from the business and putting them back in, taking on some debt to fund the expansion of their products across different sporting activities, to enlist the help of different retail partners, etc. But that changed in 2013 as GSC actually acquired another company. So they no longer were expanding just in an organic way. They bought 100% of the shares in a sports shoe company called Sportswear. That was their first entry into footwear, which is one of the three main categories in sportswear. And following this acquisition of Sportswear, they rebranded the Sportswear shoes as GSC. So what we see here is that GSC is focused on both product and market development in accordance to Ansoff's matrix. So they've employed both approaches, new products and new markets. So we're looking here at the characteristics of the high growth early stages of the company. They're taking on debt, they're reinvesting the money they make from the business, and indeed they're coupling that with the acquisition of companies from 2013 onwards. And furthermore, to power the growth of the company even more, the business decided to list on the GLN Stock Exchange in 2012. That also raised funds, so they've debt funding, they're using their internal funding, and now they have equity funding from shareholders. That allowed the company to reach 150 countries across 4 key regions: North America, Latin America, Europe, and Asia Pacific. So we're told of the 2 sales outlets that the company has, the 2 primary sales channels. It sells through its own websites and it sells through retail partners' outlets. At the moment, GSC does not have its own retail outlets. Now, I think given the fact that this point comes up at numerous points throughout the pre-scene, that it's a likely exam question. You'll be asked maybe how beneficial it might be for GSC to open its own stores and sell through those own stores, because a number of its competitors are doing that at the moment. So they're the sales channels that the company has, its own websites and third-party retailers. So, as a publicly listed enterprise, there are obviously benefits that come with that. There are more financing options available to the business, as they can tap into not just debt financing or internal funding, but they can also use shareholders' funds as well. Companies that are listed publicly tend to have better reputations, as they are subject to the scrutiny of investment analysts and the public at large. However, as a publicly listed company, there are some onerous regulations in the form of compliance for the filing of financial statements that need to be audited. There is pressure from your shareholders. They expect a return in the form of a dividend payout or an appreciating share price. So there's all of that public scrutiny that comes with being a publicly listed enterprise. And just coming back to the fact that the company is not selling through its own retail stores. Indeed, it's not particularly vertically integrated. If you look at its value chain, it's not manufacturing the goods that it's selling, and it's not selling the goods it's selling, at least not the bulk of its goods. It's selling, I think, about 30% of its goods through its own websites, but 70% are going through third-party retailers. So it loses out on some of the benefits of a more vertically integrated operation that could make cost savings as they kind of consolidate teams that are duplicated over different parts of the value chain, etc. Looking at the historic revenue performance on the next page, we can see that it has been an upward trajectory for online sales, and we've got the 2020 forecast included here. What's immediately apparent here, besides the fact that the company is growing very nicely indeed, in fact, it's registered a doubling of revenues between 2015 and 2020 for all of the three categories that it sells. However, you can also see that clothing is by far and away the most important revenue generator for the business. Footwear and accessories are very niche offerings indeed. When we look at retail partner sales, up to 2020, you can see that the growth has been flatter since 2015. There's been 27.5% growth in retail sales between 2015 and 2020. And again, we see that it is predominantly clothing that is accounting for most of the revenues there. When you combine the online the online sales plus the third-party retail sales, you can see that the bulk of the sales go through retail partners. With a minority of the sales coming from online sales. However, given the fact that the online sales have grown more rapidly, you can see that they have gone from about 20% of overall sales in 2015 to about 32% of total sales in 2020. So online sales have become more important. People are more comfortable all the time with buying goods online, whereas that wasn't the case in the past. And if they can go on selling more of their goods online, it's likely that they could drive some costs down because they're not having to pay a commission to third-party retailers, etc. Clothing and accessories show increasing revenue, whereas footwear revenues appear to be more stagnant. So that's something we will come back to later on. Footwear seems to be a little bit of a problematic category for the company.